everyone, thanks for checking out my channel. Going to do some analysis on WTI crude oil after quite an interesting week and potentially some trigger for longer term and the downtrend I was looking for quite a while now, or at least some more consistent correction we got and reversal of the uptrend. So yeah, I'll do that a bit in a different way, mainly focusing on the technicals. So I think I went through the fundamentals and analyzing supply and demand over the last few weeks to find out that potentially the $40 level is the balance level on the market, and that there's pretty much not much else that will happen in terms of rebalancing that market. So this is pretty much a status quo from now, and I believe the technical will now take over, so we'll be able to trade on the chart without looking too much at the fundamentals. And for example, when you look at the inventory reports we got the last 2 weeks, we had one massive draw, 7 million I believe, and last week we had there was a build 7 million the week before, then we got a draw of 10 million last week, and it had almost no impact on the price. Nobody reacted to it. There was some small some spikes and some bit of volatility around these numbers, but relatively these numbers are absolutely huge. In a normal market where the fundamentals would be driving the price, you would see that kind of numbers triggering like 5, 6, 7% up move, down move very easily. So it means that volatility compression, regardless of the fundamentals, in my opinion, is a switch that is driven by the technicals, and I'm going to explain why. Looking at the chart, and I'll be comparing the current configuration with the March 2019 as a benchmark. So if you look back then, we have very similar configuration. I'm using that example to try to anticipate what could happen in the coming weeks, because we need to be ready for this. That's going to be a long trade, but probably highly rewardable if it does actually work. So looking at that figure here, similarly we got the rising wedge configuration that we can see here, starting from the low at 42 and up to 66. We had a continuous higher lows, higher high, but we can see that the lower trend line is actually more inclined and showing a little bit of a decline in terms of the buying pressure and the selling pressure building up to the top. So of course, if we look now at the current configuration, here we have exactly the same similar configuration. So that wedge could be drafted different way. It doesn't actually really matter so much as long as we're just capturing the lower end of this. So we can take that bottom and take all the wicks down here and close somewhere there. It is not actually that important, but just the shape of the move is actually critical. So yeah, the rising wedge is usually a reversal pattern, so very unlikely to break out, and usually reversing the trend for long term. No, something very important as well, we had the daily 20 MA breakdown, exactly the same configuration back in 2019, and then we can see that the daily 20 MA got actually worked very well here. So we can see a first touch here, another one there, another spike down here, and finally the last one we got was that breakdown here that we can see that did actually confirm the trend reversal. Now if we look at today, the current situation, we had exactly the same thing. Looking down here with the first touch on the 20 MA here, we got another one here, another one there, and finally here we got the breakdown. It's probably a bit more visible if I zoom in. So we are on the daily chart, so relatively long term, and we got that breakdown here of the 20 MA. It's been very important in my opinion, and the price could not actually move back up. So we got that break a couple of times here, but all the time it got bought back very quickly, and we closed with the price above the 20 MA on the daily chart. So very important. another thing, we got the 61.8 Fibonacci level to watch. If we take that 2019 move, we can draw pretty much the same thing, taking the high of the previous, got that drop down to 42, and we can see here that we got 61.8, so it did actually overshoot this a little bit, but the divergence did actually start showing at that level. And if we look at the current situation, this is pretty much the same, taking the top here to the bottom. So I consider the bottom to be around 10 because I disregard the May contract that crashed negative. I don't believe that's that relevant, and it was just a one-off thing, but the continuous chart would actually show continuation of the move, and 61.8 didn't actually overshoot it yet, and I don't believe it will, but just to give some sort of a level indication, we are really close to that kind of retracement on that the previous drop we had that was less sharp, of course, back in 2019. The move down was actually end of 2018. It did actually last for a few months, end of 2018, and it was less important than what we got this year, but still comparable in terms of what the rebound or the retracement did actually mean. Very important as well, the daily RSI. We got the support trend line breakdown that's happening with the daily divergence. So if you look back again here, I hope there's not too much noise in the background. There's some people probably gearing up for Saturday night, so yeah, hopefully there won't be too much of a problem. Yeah, so back there, we can see here from that top at 64 up to 66, we got that big divergence here on the daily. So that was of course a very big selling signal, but all the time we got from the bottom to the top, we got that divergence. Just put that in red, trend line, and the price did actually come and touch that all the time, checking out really nicely. So we got one here, another touch here, another one here, and even some sort of a bounce again at that level, and then we finally got the breakdown at that level, which is of course similarly the breakdown of the 20 MA. And now if we look at the current situation and what happened last week, we got exactly the same thing. So we got that daily divergence I was talking about for quite a while, and we had horizontal support line just here. Let's change the color again, and increasing this, we can see that we got many touches, one here, and finally one here, and last week we broke that support line, very obvious, as well at the same time we broke the 20 MA on the daily chart. So very important in my opinion, because it means that the momentum is building up on the seller side. The buyers are actually giving up that support. They cannot build momentum, and we can see with the candles they're actually getting smaller and smaller, and we can see that the red candles are actually getting quite large, and last week we had a very large drop on Thursday, but the buyers were not able to actually bring that much higher or bring it back. So yeah, I think this is the similarity between the two is quite big. I'm talking only technicals here. I understand the environment completely different. Potentially the oversupply is more important at the moment, and of course the economy is in a relatively bad shape. Back in 2018, I think we had a major drop on the stock market, but the economy, sorry, just move that. But the economy at that time was still doing okay. We have that interest rate rising that was actually putting price on pretty much everything. That was explaining that drop very likely. We are in a completely different situation now. So arguably, this price here at 42 is potentially too high given the status of the economy. Now, talking about the target that we could get for the move coming forward. So the first drop toward the rising range target, we can see here 2019, as usually draw it that way. we got the start of the wedge pretty much, and the first target on the breakout would be pretty much here. So we got the first target was 57. If we report the same on the current figure here, let's assume we go from here to here. It could be a bit too much maybe. That breakdown will take us straight to 34. So the $34 would be the first target for that drop. I believe this is highly achievable. Also 34 is actually where we've seen some support on the gap down we got in March this year. Very important level, so we'll definitely show the buyers here. Of course there will be some other levels, like 37 is very important, but I believe 34 could be the one. Having said this, there's a major difference between the two configurations, is the divergence. Because of course in 2020 we have a very long lasting daily divergence, which means that we're having a lot more volume building up in that move here that will actually sell back when the move will start to reverse for good. So I believe the momentum could accelerate further, and I'm actually not 100% sure the 34 level will necessarily hold should we see the momentum building up. Back in sorry, I'll just put that back, 2019, got the first target here was dropping at 57, then we had another good 10% lower, so technically we could actually see the 30 level. Should we have another 10% adding to that move, that will bring us to the point 382 on the Fibonacci retracement. So yeah, believe definitely there is something here that is very interesting. The strategy I'm gonna apply from here will be to accumulate short position, so I'm not interested in buying WTI anymore. We also have that trend line that's been checked many times last week and the week before, ending on that spike. So I believe we are going to have now the daily 20 MA will work as a resistance, so 40.5. We're gonna have above 41 will be massive resistance, and I'm expecting some more sideways, a little bit of some distribution probably moving forward, so we could see the price trying to break higher, then consolidate a little bit here. We're gonna get some support at 39 for quite a while, and following this should get some breakdown to the lower end of the first target, that would be 34, and then we will reassess the situation. Of course we can reassess also at 37, that will be already about 10% down move, so potentially taking profit from here should we go there, but it will all depend on the configuration, also all depend on the stock market and what the economy will do. We're still having a daily divergence on the S&P 500 that could actually help triggering that move further down should the stock market start to correct from the current level. So yeah, I hope you found this interesting and useful, of course, for your trades. I will be following this very closely and see how we move. Of course, if there's any major break out above 41, say even 42, then it will have to be reconsidered and invalidated. As always, trading is about probability. There's no certainty in there. That's one scenario I believe is the more likely to happen. Will it happen? I have absolutely no clue. I don't know, not reading the future, unfortunately, but yeah, I think high probability for this trade to be successful versus continuation of the move up. There's many arguments pointing to this, and I believe the chart will be the one to be looking in the coming weeks for this, before potentially the fundamentals will actually kick in again. Should we actually start dropping too low with the price, then we can see some OPEC actions. Also the US potentially seeing more bankruptcy or whatever, or putting rigs down again, or that kind of thing, that will start rebalancing the supply demand, then the chart will be less relevant. But at the moment I think we're going to enter a very chart trading situation that is probably more comfortable and easier to read for traders. yeah, thanks for watching. Have a nice weekend, and speak to you soon. Cheers, bye.